So, the big question is this: how are entrepreneurs and real estate investors like us, ones who want to grow our businesses and who are tired of paying for really expensive alternative lending? How do we tap into the most inexpensive money available and do it without the hassle of typical borrowing? That is the question, and this podcast will give you the answers. I'm Merrill Chandler, and welcome to the Are You Effable podcast. This is Merrill Chandler with Are You Effable podcast. In this episode, we're going to be talking about the credit score pyramid. We're going to be talking about ranges. We're going to be talking about tiers. We're going to be talking about how lenders are making money off of you and you don't even know how. All of this in this episode. Join me. We'll be right back. Welcome back, guys. Are You Effable podcast. Your host, Merrill Chandler, and we are going to do we're going to take a look at what I call the credit score pyramid. And this is an invention of mine that kind of encapsulates exactly how lenders are playing you and making money off of you, and you have no clue. And they're using some of those scores we talked about in previous episodes. They're using some of those scores to actually leverage how much money they make every single time. So let's get into it now. First and foremost, let's take a look at the pyramid itself. All right. The top of the pyramid, the height to the bottom is score. That's the score range from, in this case, we're going to use the unweighted scores. You even know what I'm talking about now, right? We're using unweighted score ranges. 850 the highest, 300 the lowest. But this credit score pyramid is for every type of, can be applied to every bureau and every type of score and version. So it could go from 250 on the low to 900 on the high if we're using quiz time, if we're using FICO weighted auto scores and bank card scores. Good job. That's correct. So 850 to 300 low is what we're using here. So that's the FICO credit score range for unweighted scores. Now, the base of the pyramid is actually what we're looking at when it comes to the range between your highest and lowest scores. Highest and lowest scores is the range at the bottom. So the base of the pyramid is represented by the difference between your high score and your low score. All right, we took a look at some of those scores and different versions and different, etc. But this is calculating across all three bureaus. So different ranges and different versions are the upper lower, and then the range between your highest and lowest score is the base. Now, let's take a look at tiers. Credit tiers are groupings of scores, and they usually go anywhere between 20, sometimes as high as 40 points between in different tiers. And autos have different tiers. We'll cover it in a second. Autos have different tiers. Bank card scores have different tiers. Even mortgages have different tiers. But these tiers are vital because remember how we were saying when Brad went to buy an automobile with his daughter, he said all of my scores were within a few points of each other, and they all fit in a particular tier. It doesn't matter which bureau or version you choose if they all fit within that tier, because tiers are where financing and terms are. It doesn't matter if you have one or two or three scores within a tier, because the tier is what dictates the terms and your interest rate, etc. Okay, so it doesn't matter if you're 720 to 739, you're going to get in this example, you're going to get the relative same financing terms and interest rate. All right, now, the next thing we want to look at is that in these credit score tiers, all of the credit score tiers, the height and the range, this is the composite of all of the, what I'm looking at right now is the 850 all the way down to 300. the credit tiers, and there's usually 7 to 9 tiers, and the range between your highest and lowest score. Now, here's what's fascinating, guys. An auto tier 1 is a 720. Auto tier or mortgage tier 1 is a 740 or higher. Now, these are floors, tier floors. And by a floor, I mean an auto tier 1 is 720 or higher, but you got to have a minimum or floor of 720. A mortgage tier 1 is 740, or the floor has to be at least a 740. And to get 740 tier 1 rates, your middle score for mortgages, your middle score has to be the 740. And then a business line of credit tiers or bank card tiers, tier 1 is 760. Now, can you get qualified for less than this? Of course you can. But these floors are indicating the favorable interest rates. Now, there are even better rates. If you have an auto tier 1 and you're an 820, a real 820, I mean a fundable 820, you will have better rates and terms than a 720. But this is the floor. This is what this is what the industry considers as the bare minimum for the best financing or extremely favorable financing. Now, what we want to look at here is that across the bottom, the base of your pyramid, if there is a 20-point or greater range between your highest score and your lowest score, right? And that highest and lowest score is by version. You're not comparing 9 to 8. You're comparing, if you're using FICO 8 auto, then if there's a 20 plus range on FICO 8, you're going to get manual underwriting. Okay? Because anything above 20-point difference, what we have inferred from all of our data and all of our student and client experience, right? This is not an algorithm that says this. Our experience has been that all these ranges cause borrowers to get put into manual underwriting. Because if there's 20 or more point differential, that means that the lenders can't trust the data. Well, is it 740 or is it 720? What's the real score? That's why mortgages take the middle score, because they're just playing it safe. But many auto dealers will pull 1 or 2, sometimes 3 scores only if they doubt the integrity of the data. Is that making sense? Right? So what we want to look at here is 20 plus, no bueno. But 0 to 10 points is bueno. It's awesome. It is that 10 point, and that's the range that we talked about with Brad when he said, "Oh yeah, I'm all if you can pull an Experian on the previous episode, if you can pull an Experian and I'm safe. I'm all in the same tier," because you can cross over tiers, and there's certain times that where you're tier 1, tier 2, or tier 3, but you may cross over. Then you want to choose the score and the version of the software and the bureau that represents the highest possible score. In this case, Brad's were all within the same tier, so we could tell that auto dealer, yeah, go ahead and pull any one of those Experian. If you can approve me with Experian, then you got my business. Well, here, 0 to 10 point range is very trustworthy, especially if it stays within the tier, okay? Because tiers dictate rates and terms. All right, we stay in automatic underwriting anytime that we are in that 0 to 10 points range between the highest and lowest score. Now, so great. I'm telling you all this stuff, and you're like, well, what is knowing this stuff even, why does it help me, right? What does it even matter? And just like I told you, getting played by the auto dealers or the big ticket merchants, you're getting played here too. And there's a way that there's a certain, I don't want to call it prejudice. There's a FICO and the lenders are feeding us a line that says that is not completely, that's misleading. That's not completely true. I'm not calling them out as liars, cheaters, and thieves because it's not so blatant, but they are, perfect way to say it, they are grading on a curve. All right, so let's take a look at what I mean by grading on a curve. Let's go back. So the credit score, average national credit score is from FICO is right between 700 and 710. Right down the middle, right? National average. Did you realize, though, that lenders maximize their profit? Did you know that lenders maximize their profit at exactly the same score range, 700 to 710? Okay, does that feel a little suspicious to you? You would think that they would be making more money in higher interest levels. But this is what I mean by grading on a curve. So FICO predicts, remember predictive analytics. FICO predicts that at a score of 700 to 710, not 720, not 760, not 810, FICO predicts that between 700 and 710, that a lender will get 95% of their principal repaid plus interest. But because it is a lower tier, this is like tier 3 to tier 4, depending on whether it's bank cards or auto loans or mortgages, they get to charge 30 to 50% higher fees and interest on that score, 700 to 710. Did you hear what I said? FICO predicts, and lenders are most profitable in the score range of 700 to 710, even though it's tier 3, maybe even tier 4. They're making, because they get 95% of their principal repaid plus interest, but the interest is 30 to 50% higher in fees and interest rates. So think about it. That's what I mean by grading on a curve, is that you would think that if you're going to get 95% of your principal back, that the interest rate would be a little bit higher, but not hugely higher. But because they know that they're going to get 95% of their money back, guys, because remember, they're the ones who set up the scale. They're the ones who set up the grading process and the tiers. So we just take it for granted. Oh yeah, Merrill, you're tier 3, so I'm going to charge you 6.5% interest instead of 4.5%. Why? FICO predicts I get 95% of my money back, says the lender, plus interest. And the interest is much higher because of this low tier, right? Do you see how we're kind of grading on a curve, and they're stretching the realm of fundability to make a grip of money off of those who have average credit. And the average credit rating across the country, 700 to 710. That's weird. That's why I said that lenders are most profitable if your score is at the 700 to 710, because they get most of their money back and they get to charge way more interest. Now, let's throw in a new concept. Remember one of those scores that we talked about? One of the scores that FICO uses it's called the revenue score. And this revenue score predicts, given a particular score and a particular zip code, FICO predicts how much money they will make off of that lender. I'm just choosing $500. That may be high, maybe low. But think about it. Based on your zip code and your credit score, they can predict to a fairly a predictable profit margin of how much revenue a lender's going to make off of you. All right. So let's talk about it this way. But how does that help us? How is that a massive win for us? Because a lender, if you know quarterly profiteers, if you know MBAs, if you know people who are in the business of making money, they want, it's called I don't know what the lenders call it, but it's revenue per client, right? Revenue per customer. What is our average revenue per customer? Oh, and we're able to raise that revenue per customer. Well, FICO predicts that there's a revenue per customer based on their credit score. And if you're in the 7 to 710, in this case, let's say they're going to make $500 per year for all those averages. So they, no matter who the person is, who the borrower is, they want to make that $500 per borrower. Am I making sense? They want to make the same or more amount of money on average, because that's how they can predict quarterly profits. That's how they can predict growth of the business and taking care of their shareholders, et cetera, et cetera, et cetera. So even if you're at 700, 710 and you're making $500, they want to know, what do I have to do to make that same $500 from somebody who has a tier 1 760 plus? What do I need to do to make the same $500? And you know what that is, guys? You're going to love this. They're going to give 2 to 3 times the credit limit or loan amount so that they can make the same amount of money. You with me? To make the same amount of money, it's the same application. It's just they have to give us more credit lines in order to make that same amount of money. You see what I'm saying? So here, to make the same amount of money as I do with 710 or 700 to 710, I've got to expand that credit line. I've got to expand the credit line 2 to 3 times. So instead of getting a $5,000, I'm going to get a $10,000 or $15,000 credit line, loan amount, etc. Because they want to make their quarterly profits demand that they make the same amount of money in that construct. Okay? Is that good news for you or bad news for you? If you know what you're doing to create fundability, this is amazing news, because as we're going to learn in future episodes, that it's called the velocity of credit. And the more time you spend building the right kind of profile on the personal fundability side, the more your business is fundable, the more money you're going to make, and the more opportunity you're going to have, because now you're going to get, instead of a 10, you're going to get a 20 or a 30. Instead of a 5, you're going to get a 10 or a $15,000 credit card, credit line, loan amount, etc. All right? It's the same application, same data, same everything. But because you know the rules of the game, you will be able to understand why you're getting lower amounts or you're getting higher amounts. That credit score pyramid awareness of the credit score pyramid is vital, because we want to stay in automatic underwriting. We need the difference, the range between our highest and lowest scores, whichever version of the software we're using. What we need the range to be 10 points or under. We definitely need to be under 20 points so that we can stay in automatic underwriting, because this is all automatic underwriting. It's calculated by this automatic underwriting software. And that's the only place that you're going to find that information. So, guys, awesome stuff, right? I mean, this is crazy awesome. I don't know what are you binging number 2 or 3 or 5 or 15? Guys, I'm telling you, if you haven't seen the visuals, make sure that you either go to fundinghackers.com and go to the blog and look at the graphs there, or watch this same this is a video podcast. Watch it so you can see my smiling face calling you out to your greatness, so that when you file an application, you're getting the most amount of money possible. Fair enough? My name is Merrill Chandler, and I'm your host of the Are You Effable podcast. And I want to see you immediately again on the next episode. Hey guys, thank you for listening to Are You Effable? Please leave comments because I would love to read about your aha moments from this episode. And be sure to visit fundinghackers.com to view the blog post, get important links, join our community, and much, much more. And you gotta tell your friends about this podcast. We want them to become effable too.